Price, that's the number one technical indicator.
You do best by investing for the longer term.
If you can't explain what the business is doing, then that is a huge red flag.
Some technological change is going to put you out of business.
It really is a genuinely extraordinary situation.
Welcome back. I'm Hayden Brain, and you're listening to Opto Sessions, where we interview the top traders and investors from around the world, uncovering their secrets to success. Richard Lightbound is EMEA and Asia CEO of ROBO Global, an index advisory and research company helping investors capture the unique opportunities presented by robotics, artificial intelligence, and healthcare technology. Each of those themes within the disruptive innovation landscape is represented by a ROBO Global index, and cumulatively, those indices have accrued close to $5 billion worth of assets tracking them. We discuss how the company's strategic advisory board, made up of best-in-class researchers and PhDs, identifies new investment opportunities, which subsectors are currently on Robo's radar, and how the team uses a Robo score to gauge a stock's investment merit. Enjoy.
Welcome, Richard. It's great to have you on the show. So how was your weekend?
All good, Hayden. All good. I was actually recovering from, I did my first road trip for literally about 2 years now. So I was in Brussels and Switzerland last week. So yeah, a nice one at home.
Yeah, lovely. Okay, great. Well, let's get into the main body of the interview. So I'll ask a question that won't necessarily flow chronologically, but it will give listeners an early indication of one of the focuses of today's interview. So how do ROBO Global, in your opinion, define disruptive innovation?
Yeah, it's a really important question. So for us, disruptive innovation is all around significant technology events where we're seeing large-scale, long-lasting changes across many different industries. So, the easiest way to sort of, narrow that down a little bit is to think about something like robotics and automation, which we actually started to research over 8 years ago. And for us, robotics and automation is a set of foundational technologies that is changing not just manufacturing and warehouse and distribution centers, but this technology is being deployed into healthcare, onto farms, it's entering our homes, it's driving our cars. And that's exactly what disruptive innovation is about for us. You've got to have that large scale element to it, and then long-lasting changes. We're going to see a number of industries significantly change. We're going to see all sorts of new industries and companies emerging as a result. So something that's very narrow for us is not disruptive innovation. It's got to be broad, large, and long-lasting.
Yeah, fantastic. That makes a lot of sense. It's something that we cover heavily on Opto. So I'm keen to get under the hood of disruptive innovation in general, your research process, how you identify businesses and opportunities within that space. But as I said prior to the call, we'll do that in sort of 10 minutes or so. But first, I want to set the rest of the interview in context, I guess, and introduce you to the listeners, anyone unfamiliar with your background. I think this will be useful for them. So going back to 1999, I believe, you were working in Asia, first for a company called TradeCard, where you were located across Hong Kong, Europe, and Sri Lanka, before you took the Director of Global Trade Services role at Wells Fargo. So that role saw you located in Hong Kong too, I believe. So how did you first find yourself working out in that part of the world in the first instance?
Yeah, so I was quite fortunate. I actually got into a US bank. I did a credit training program right at the beginning of my career and really ended up in Hong Kong immediately. I think it was either join their international team or stay home in the US and focus much more on domestic lending businesses, which just didn't sound very exciting. So went out to Hong Kong, as for a lot of people, it was meant to be a short stay, and 2-3 years rapidly zipped by and ended up being close to 15 years. And yeah, as you said, Hayden, I made a switch in very late 1990s to a startup company called TradeCard. We were a very early cloud computing company. I think even before that phrase was coined, we were funded by a major New York VC company. And I think that's what gave me a bit of a taste for disruptive innovation. We were bringing a cloud computing solution to a very traditional area of commercial banking, and it was hugely successful. The company actually got sold, and I moved on. Actually, went back to banking until we got ROBO Global going.
Yeah, no, absolutely. And you kind of alluded to it there when you said that it was meant to be a couple of years, or you thought it might be a couple of years, but it turned into 15. And I wondered kind of what kept you out in that part of the world, Hong Kong in particular. Why were you keen to remain there? What do you like so much about that part of the world?
Well, I'm sure, Hayden, that a few of your listeners have travelled there or been lucky enough to live there, like myself. It's just a fantastic part of the world. It's very dynamic. It's very entrepreneurial. Businesses tend to be thriving when they're out there. They're in sort of that expansion mode. They're trying to sort of extend their reach into China. Hong Kong was always that natural springboard. So you just end up involved in an awful lot of businesses, opportunities. You get to meet a real melting pot of people across different cultures as well and work with them. And I just think when you're away from home with that sort of group, you're sort of your best friends start to become your extended family, and your roots start to go down there. So it was actually, for myself and the family, it was a big, hard decision to leave.
Yeah, well, I can imagine. I think to work through your sort of career history to date chronologically, you subsequently took roles at Standard Chartered, I believe, most recently as Greater China and North Asia Head of Bank Sales. Again, I think based in Hong Kong. But to what extent do you draw on this first-hand experience of Chinese and Hong Kong markets in your current role? How important is that on-the-ground experience, do you think?
Well, I think, as we said earlier, when you asked me about, what is disruptive innovation, for us, it's got to be something global. So, I think, I was fortunate, not just to be based in Hong Kong, in Asia, but to have very regional roles. You just mentioned one that was North Asia, but previous roles, I was actually traveling around South Asia, the Indian subcontinent, the Middle East as well. And it just gave me a real taste for sort of different industries, different economies, different people, different ways of doing things. And I think that's important when you're trying to think about disruptive innovation and, the impact on the global economy. It will impact different regions, different economies, different industries in different ways at different times. So, the more culturally aware you are of that, the better.
Yeah, no, absolutely. And about being culturally aware, I think maybe that's something that could be, or at least culturally unaware, could be leveled at foreign investors. I think there's a lot of popular misconceptions about Asian markets, and I wondered whether you could help us disprove a couple of them, perhaps. I mean, for example, what do you say to kind of foreign or international investors concerned about a perceived higher level of risk in Asia equity investments? Do you have any thoughts on that?
Well, look, I mean, there's clearly risk in all equity markets. I think, perhaps one of the more obvious ones that perhaps I would, sometimes agree with is just, around transparency and governance in certain markets and the underlying companies. But beyond that, emerging markets, I can't think of anything much more exciting to have exposure to. I mean, you're missing out if you don't have an allocation in your portfolio, to those sort of markets. They are absolutely the future of the global economy in many ways.
Yeah, well, no, absolutely, completely agree. And a final question then to sort of round off your career history and to take us to present day. What does a typical day, if such a thing exists, look like for you in your current role as CEO for EMEA and Asia for ROBO Global?
Yeah, that's a good question. Yeah, well, no day is really the same. But we've built a business. We've been very fortunate. We started off putting ROBO Global together simply because we wanted to invest our own money into the robotics and automation theme. And this goes back sort of 9-10 years ago now. There was nothing available. So no funds, no ETFs, no indices, just no way to really get broad exposure, which is what we wanted. So we teamed up with a number of analysts, some industry experts. We started to put our early strategy together. We actually effectively got it launched as an ETF in the United States originally. And there was just a huge amount of investor interest, not just in the US, but also in Europe and even in Asia. So that kind of led us to think, well, we can commercialize this. We can really, if we put some focus behind this, put a bit of capital into the business, we can grow it. And we've kept the company very private. We're owned by individuals. We're very selective, effectively, who we work with in terms of product partners who launch ETFs and funds. There's now about $5 billion of assets tracking actually our three strategies, not just robotics, but also an artificial intelligence and a healthcare tech strategy as well. So, but my job really is, helping our research team keep the strategies up to date. So, we do regularly meet the management teams of our index companies. For me, that involves traveling around Europe, which hopefully we can get back to with a bit more normality. We also then, as I said, work with product partners, ETF partners. We actually work with legal and general investment management in Europe. So I'm quite engaged with their product and their sales distribution team as they go out and sell their ETFs. And spending time with my US colleagues as well. I think a typical week is probably an easier way to answer it. Pre the pandemic would be a couple of days of traveling on the continent, day or two in London, and a day working from home.
Yeah, absolutely. Well, let's use this juncture then to focus on ROBO Global's research process, just to better understand, I guess, what differentiates you from other peers within this space. So on your website, ROBO Global is described as an index advisory and research company. So all those services are there to help investors capture the outsized opportunities in robotics, AI, and healthcare tech. And you've touched on it already, but I wanted to sort of dig into this interplay between the advisory and research side of the business and then the index formulation side of the business. How do those two elements kind of coexist? And can you give us a bit more detail on that?
Yeah, I would love to, Hayden. I think, when you think about disruptive innovation, and again, this takes us back to, when we started ROBO Global and initially looked at robotics and automation, I think investors have got to be very aware that, obviously these are disruptive themes. There's a lot of underlying technology. That technology is evolving very, very, very quickly. It's highly adaptable. So, just like the examples I gave earlier with robotics and automation, you can see this tech being redeployed and almost reinventing itself into lots of different areas of society and industry. So I think from the outset, we realized that it was going to take a lot more than just traditional research and financial analysis and, that sort of backward looking view and just looking at the past year financial performance of a basket of companies to say, who do we want to invest into? We almost wanted to do the opposite. We actually wanted to start by looking forwards and looking at a theme like robotics and automation and saying, okay, how does this map out? What are different areas of industry we want to invest into? And then also, what are some of the underlying technologies we want to invest into? And the only way to do that is to team up, as we have done, with some industry experts. So real technical experts who understand the world of robotics, automation, AI. And what they've helped us do, and we keep this updated over time, but is to really build a roadmap, if you will, or an industry classification. So to date for robotics and automation, we've identified with the advisors 11 subsectors that we focus on. And then our job as a research team is to do some more traditional, if you will, fundamental analysis over our portfolio of public companies and really find that the best in class companies. So you'll probably get to it later, but we have a scoring process that we take companies through. I won't go into the details now, but it's effectively the highest scoring companies across each of those areas within our 11 subsectors that ultimately go into the strategy. So that interplay, as you called it, is it's a perfect word where if you look at the Robo team, our research group is actually based in New York. It's a group of senior analysts. They've worked on the buy side, the sell side. They've been portfolio managers. We've got a very heavy quant guy. And, their job is to really be guided by the industry experts. So this advisory board has got 7 individuals who have PhD after their name. Perhaps that's not very exciting, but just to give you a caliber of the level of these PhDs, Jeff Bezos of Amazon every year has a gathering that he calls Mars. And it is as spectacular as it sounds. He actually gathers the top 200 disruptive tech minds from around the globe. So entrepreneurs and technical experts. It's a hard cap at 200. So obviously a pretty competitive event to attend, if you will. But 4 of our 7 PhDs are regular invitees to that event. So, super senior technical experts, they're big entrepreneurs themselves. One of our strategic advisors was a co-founder of what is now Amazon Robotics. So the technology that allowed Amazon to start to automate their warehouse and distribution centers and build out their prime next day delivery program. He was, again, a co-founder of that company. So, yeah, but back to where your question was, Hayden, that interplay is absolutely critical. We would have a very different portfolio if, as a research team of analysts, we didn't have this researcher strategic advisory board wrapped around us.
Yeah, no, absolutely. That really helps to sort of flesh out the expertise that you're able to incorporate as part of your process. And that underlines, I suppose, how you differentiate from your peers and potentially where your edge comes from. But if we just go back to the process, I mean, you talk about ESG on the website as well, when I was doing my research before the call. And I think a lot of companies look to incorporate some ESG element within their research process, but you seem to do it quite differently and quite distinctively, I suppose. I wonder whether you could illuminate us on how you actually incorporate ESG within your investment research process.
Yeah, no, I'd love to. So I think the first point that's worth making is, one of the many reasons we like these three strategies that we focus on and the underlying portfolios is that they actually have a very natural tilt towards sustainable investing. And to be honest, pre the pandemic, particularly with the robotics and automation strategy, we often had a tough time with investors convincing them that there was this natural tilt, because the obvious question, and it came up in every meeting, every conference, was, well, robots are bad for jobs. They're going to take away, everyone's jobs. And we used to say, no, that's not the case. Robotics and automation will bring change to society and industries. There'll be, totally new companies, totally new opportunities. And yes, a lot of traditional areas of industry will change. So we've never said there wouldn't be impact, but for us, robotics and automation, just as one example, has always, fundamentally been about driving productivity, efficiency, making better use of natural resources. Really easy example in our healthcare subsector in the robotics and automation strategy. One of the areas or themes that we play is around surgical robots. There's a market leader there. They've got thousands of their platform installed in operating theaters globally. There's been several million procedures performed, but that piece of technology is never going to replace the surgeon. The surgeon is still there. The surgeon is still behind joysticks, looking at a screen, actually controlling the surgery. But it makes it easier for the surgeon. They can actually sit comfortably. It minimizes their movements. The AI can actually help them with the operating plan that they're going to be going through, and potentially, and it's starting to happen, a surgeon can even be remote. So we've always argued that the strategies have this natural tilt towards sustainable investing. If you fast forward through the pandemic, I think that started to give us a little glimpse as to what highly agile, digitized companies or industries actually look like. If you think about telehealth or e-commerce, it was companies that did have that digitization of their businesses that really started to thrive. And I think as we've emerged from the pandemic, that need for automation now has it's never been greater. It's almost, I don't want to sound too dramatic, but it's a little bit of an automate or fail for a lot of companies within certain industries. So, for us, actually introducing a more formal ESG policy wasn't particularly difficult. We had this natural tilt towards sustainable investing. Back in 2017, this became an even more important theme for investors. It's always been important for us at ROBO Global as well. But we really just put in place a more structured exclusionary screen where, based on our research, our regular engagement with the management teams at companies, we actually have a number of flags and filters around ESG. And if a company doesn't pass, we remove them. It's actually pretty straightforward. We've got examples of that happening across the three strategies.
Yeah, great. I just wondered what sort of criteria make up that more formal ESG policy.
Well, if you start sort of at a high level, it's human rights violations, it's weapons of mass destruction, anything that sort of contravenes ethical norms and expectations, and then underneath those three areas, we then drill into an awful lot of, detail and get very granular about different areas where, sometimes we might have a tolerance where we might say, well, perhaps 5% of revenues focused on this area is okay. Where a company is perhaps providing services into, say, an oil and gas industry, we will actually look very carefully and say, well, what exactly are those services doing? If they're actually helping a particular set of companies be more efficient in terms of how they extract the oil or distill or get the oil out to end clients, then that's not necessarily all bad. So there's lots of different lenses that we put on, exactly what a company is doing. We have a very detailed ESG policy that's actually on our website. So it takes readers through exactly what we're looking at in different areas, what those tolerances are. I think it's important to stress this is very much an internal ESG policy, but we do subscribe to some external data sources as well to help flag potential issues early or just get a comparative set of data. But what's amazing, Hayden, is when you look across different data sets around ESG, they're wildly different. So sometimes one provides one thing, and then you look at another data set and they say, no, that company A is absolutely fine. They pass our ESG filters. So, we're not reliant on one external party in terms of data. We tend to sort of aggregate external data with our own research with the management teams at companies.
Yeah, no, absolutely. I think that makes a lot of sense to aggregate multiple sources. It's something we've discussed on the podcast before, but it does seem that provider to provider, you can get quite a wide differentiation between how exactly they define ESG, which can be problematic for the end investor wanting to know how ESG compliant that their strategy is. So your process certainly seems to provide some clarity on that at least. And if we consider, I guess to go back to the initial question I asked, disruptive innovation as a total investable universe, if we consider that is what ROBO Global want to invest in ultimately, why do you then focus on robotics, AI, and healthcare tech as three sort of spaces within that wider universe?
Yeah, I think it's a really important question. I mean, I think for investors, there's a lot of noise and most of it's good around, thematic investing. You can pretty much find a thematic strategy now for, and anything that you sort of fancy. But, for us, what was really important, and it really goes back to what got us excited initially about robotics and automation, is as we started to construct that roadmap, those 11 subsectors, and then we started to score potential members, what we ended up with was this very diverse set of companies. So we've always had about 80 companies in each of the strategies. We kind of like that number. In terms of how we weight the strategies, it's a modified equal weighting. So essentially, each company will be somewhere between a 1% to a 2% weight, and we reset that each quarter. And that for us is actually one of the many benefits of actually delivering the strategy as an index to the market, that sort of that structure, that discipline around the weighting we really like. So we like that broad set of companies. It's a high quality set of companies. Predominantly these companies aren't carrying any debt. What we also loved is it had a tilt to small mid cap. So 50% of the portfolio sits in that category. And then also it was super unique. As we looked at these 80 or so companies, we suddenly realized, cracky, we don't really own any of these companies in other strategies. So if you think that a broad tech indice gives you exposure to robotics and automation, in terms of how we define it, it doesn't. This is a very different opportunities. So those characteristics became very important for us as we looked at other strategies. And really what happened over time is within that initial robotics and automation strategy, we always covered healthcare. I mentioned earlier, it was one of the 11 subsectors, but it was clearly becoming an outperformer. And also there was a much broader opportunity emerging. If you looked outside of robotics and automation, there was a lot of tech and innovation coming into the healthcare system. And as we started to look at it, we realized that we were actually coming up with a universe or a strategy that had those same characteristics as we saw with robotics and automation. It was broad, it was diversified, it was unique, it was high quality. And that's what we really like about our three strategies. You don't end up with a narrow universe of, say 20 or 30 companies. We think that's going to introduce a lot of volatility. What we like about the strategies is that, it's a way to express a long-term view as to what's happening. So if, like us as an investor, you think, yeah, boy, robotics and automation, that's a game changer. That's going to have a big impact on society going forwards. We feel we've built a suitable strategy where it's really your buy and hold. It's not a short-term trading vehicle. Our job quarter by quarter is to work with the advisors, make sure, we keep the strategy updated, make the member changes in terms of additions and even potential deletions if a company score drops down or that they fail the ESG filter.
Yeah, no, completely. And there's a couple of points I want to pick up on portfolio construction. You mentioned your sort of 1% to 2% weightings across the portfolio and how equally weighted that is, the thinking and the rationale that goes into that. So I want to dig into that in a moment. But before we do, we've kind of touched on disruptive innovation as an investment theme or mega trend, because obviously it kind of goes beyond just individual theme status. So firstly, why do you think investing in disruptive innovation is such a powerful strategy now, as in right now? Is this an era defined by heightened disruption versus historic levels, for instance?
Yeah, look, I think clearly it is. And it all basically points back to technology. If you look at, computing, processing, power that's now available and what the cost curve has done, we can access, or more importantly, businesses can access an awful lot of computing and processing power at very affordable rates. Data is, people almost call it the new oil or the new electricity. And in terms of sourcing high volumes of quality data, the sensors that we've now got available to do that, are just absolutely phenomenal. So we've got the sort of, the ability to gather the data. We've got the ability to cleanse the data to make sure it's high quality. We've got the computing and processing power. We can then bolt on the algorithms, the AI, the machine learning to start extracting value, spotting patterns from that data. So, we've just never been, at this stage before as a society. I think, a really easy example to sort of bring this home a little bit is, within our healthcare tech and innovation strategy. This one actually has 9 subsectors that we look at. One of them is genomics. And if look at where we've come over the past 10 years in terms of DNA sequencing, this was a procedure, for one patient that, when it was first done was literally hundreds of millions of US dollars. That's now come down to the low thousands. The NHS actually did a big study recently involving 5,000 patients and sequencing their DNA. And, the reason that this is important is that, when you can do this at an individual level at an affordable rate, you can obviously roll it out on a large scale, but it allows you to detect very early signs of disease or cancer or other problems. So, the power of that DNA sequencing to identify early the fact that, I, Richard Lightbound, might have, a problem is very, very significant, because if I know early, I can then start to take sensible steps. Whereas if you think about our healthcare system today, sadly, we almost have to wait until you get very, very sick. We then pop you in a hospital with a lot of other very, very sick people. And we spend a lot of time and money and emotion trying to help you get better. And it's a difficult system. So if I can detect early that I might have the signs of a problem, and then you can use the same DNA sequencing to actually build a customized treatment plan just for me, Richard Lightbound, again, that's hugely significant. So, we've never been here with, this sort of, technology and tools. So I think back to your question, Hayden, I think it's just very easy as investors to kind of almost, understand or kind of, relate to a lot of these themes at a personal level. But then also, just thinking about, where the growth and returns is coming from, it's not hard to get excited. I think investors do need to be cautious, though. It's, as you were alluding to earlier, some of these, disruptive tech themes are a lot more narrow. They're a lot more volatile. And also, when you look at different strategies that have the same label, robotics and automation as an example, actually the underlying portfolios are fundamentally different. So different providers have very different views as to how to play these themes.
We hope you're enjoying the episode. For interviews like this every Thursday, subscribe wherever you get your podcasts. And while you're there, make sure you give us a star rating and leave guest suggestions along with any other feedback in the review section. Now, back to the show.
Yeah, no, absolutely. And that DNA sequencing point is a fascinating one. We actually had Ali Ehrman of ARC on the podcast to discuss that very subject. Yeah, she spoke about kind of how the first human genome took, I think, 13 years and $1 billion to sequence, and now we're down at about $100 to $1,000, and it takes a couple of days. So yeah, if that's not disruption, then what is, I suppose. But yeah, people can actually search out that episode. I think it published on the 11th of November, so I'll point our listeners to that one now. So what then if I consider the majority of our audience are retail investors? They'll be wanting to identify these companies and strategies that give them exposure to these companies. So what hallmarks are they looking out for of disruptive innovation? Is it cross-sector ramifications, declining cost curves, which I think you alluded to at the start of your answer there? What things can we highlight for them that they should potentially look to identify?
Look, I think, almost the nice thing about a lot of these themes is that, you can understand them and relate to them, as I said, on a sort of a personal level. So I think, do take the time to, understand the theme, how it's going to impact society, and then absolutely just, look at the quality of the exposure that you're getting. If someone has launched a strategy around some sort of disruptive tech theme, and then when you look at it, it's got 20 to 25 stocks, and it really just contains, large tech type names, particularly the FANGs. That to me would be a bit of a signal that actually, maybe this isn't the most sort of thoughtfully constructed strategy. You don't need to purchase, a sort of a so-called thematic sleeve, to get exposure to, large US tech or China tech. You can do that on your own, or, buy something that's much, much broader. So, I think, look under the hood, look at who's behind the strategies, what's their experience in terms of, understanding the strategies. And we think it's critical to take broad, diversified exposure. I've said it a couple of times, Aidan, so I have to come back to it. But, it's fundamental to us. We think you've got to have it, even from where we sit with our team, our research team and our industry experts. It's very difficult to kind of, predict short term what's going to happen next in robotics and automation or healthcare tech, but across the multiple subsectors that we cover in each theme, we know that there is a significant growth and returns opportunity over a multi-year period. So as long as we keep doing our job of identifying the best in class companies across each of those subsectors to sort of gather that exposure, we think that's a great way to play it. And then, don't take concentrated bets. Again, it's just too early to have a portfolio where 50% of your exposures in the top 10. We might get there further down the road with, particularly I'm referring to, the three themes that we look at, but it's very difficult, to narrow down and say what's going to happen next again, across these different subsectors.
Yeah, absolutely. I've got a question on those subsectors next, but before we jump to that, you were, I think, the world's first investment strategy to track the publicly traded universe of automation and robotics stocks. So what did ROBO Global spot that others had perhaps missed? How were you able to identify this trend so early?
It's a good question. And yeah, thank you. We were the first to put a robotics and automation strategy into the market back in 2013. So we've actually got an 8-year live track record now with that strategy. I think what attracted us to it was that there was actually some research that we were reading, as individuals, just like, members of the audience here. And it was a piece of research from a company called GavCal, and it had a pretty simple message. It was really saying, look, dear investors, please pay attention to robots because they're going mobile and becoming technologically advanced. And there were some sort of high-level examples of, this isn't just about the auto sector automation, so car automation. It was about this technology being used elsewhere in society, and it just kind of clicked. We just, as a sort of a founding team, thought, yeah, that's absolutely right. We do want exposure theme, but as I said earlier, Hayden, there was literally nothing there. And the more we spoke to the industry experts and really started to understand, the rapid, developments in terms of that tech, and that what was happening to that cost curve, it just got more and more exciting. So that's really what led us to the theme as investors. And then, as I said, we really sort of commercialized the idea, and then put it out into the market. I think what was also great for us is we didn't have to make a huge investment to get our company going. We decided very early on that we weren't going to manage our own funds or ETFs, because that does require a lot of expertise, and there's a lot of capital has to go in behind that in terms of your trading and your legal oversight, compliance, ops risk. So instead, we built a sort of a company and a process where we can spend our time researching the themes, working with the management teams of the companies and our advisors. And as I said earlier, we've then got product partners globally who launch the ETFs and funds. And yeah, I mean, if you sort of accumulate all of the assets now, it's as I said, very close to $5 billion US. So these are each, there's proven investor interest, if you will, across the three themes.
Yeah, no, completely. And we've mentioned the subsectors a couple of times. I just want to dig into kind of how exactly you define a subsector. So I read that ROBO has identified 9 subsectors within the universe of healthcare technology. If we use that as an example, I think you referenced that earlier as well. So how does the team establish if a particular niche should be defined as one of those tracked subsectors? Are there a particular set of characteristics or metrics that they look for?
Yeah, so I mean, it's within healthcare tech and innovation, there's a lot going on. So we're not trying to capture everything. What we're trying to capture are areas where over the next 5 perhaps to 10 years, we're going to see some rapid developments and advancement, and sort of companies starting to take or create market share with their products and services. So we talked about genomics earlier. That's a very easy one to talk about. Another subsector in here is what we call telehealth. So it's all about virtual and remote monitoring. Obviously, this became very topical during the pandemic, when we all had to suddenly start talking to our GP over our smartphone and our tablets. And the companies that were behind some of that tech and those products, they were seeing demand acceleration over a period of weeks that previously they were expecting to take years. And I think generally most people's experience was actually that was pretty convenient. So we're going to see all sorts of digital doors opening, not just into GPs, but much more the broader healthcare community. And when you couple that with what we can do in terms of wearable devices today, if people that have diabetes, the ability now to actually have a patch that monitors and even administers your insulin exactly when it's needed with exactly the right quantity, is very significant. So telehealth is another subsector. We can find what we like is a number of high quality companies where they've got a big moat around their tech and their teams. They're going after a big addressable market. They've already started to prove themselves. So we're not trying to invest in sort of early tech startups here. We do want established, proven businesses going into the strategies. But for a subsector to exist, but there's got to be some sort of depth and breadth in terms of the companies that we can get into.
Yeah, okay. Yeah, I see what you mean. Well, then to jump to another theme that we haven't discussed as of yet, but I think it's an interesting one, and that's artificial intelligence. I read on your website again that the AI, I think this is a direct quote, AI is not just coming, it's here. So to what extent do you think the wider stock market or the wider kind of space, peers perhaps, are actually currently underappreciating the scale and value of this opportunity? Do you think that's a fair assessment of the wider market? And do you think that's a differentiation you're able to offer investors in this space?
Yeah, look, I think, we've seen it time and time again, haven't we, Hayden? I mean, generally as investors, we all tend to sort of underappreciate, if you will, as you said, the sort of the scale of an opportunity as it's emerging. For us, across our three themes, again, just like with healthcare, we've always covered AI within the robotics and automation theme. It's always been part of one of those 11 subsectors. And again, we noticed a lot of, clearly, rapid development, advancement, and then, deployment, as you were just alluding to, that, got us excited about the theme. And it's the same story as we worked with, our advisors. One of them, she's at MIT in the US. It's known as the birthplace of AI. She runs what's called their AI lab there. So as a sort of an industry expert and thought leader and entrepreneur, that's a great person to talk to about AI, and we can do the same with some of the other advisors. But I think what was becoming obvious for us with AI is that that sort of merging of the growth of data, the chip processing power, the breakthroughs with AI related software, the infrastructure, and also just a transformation of the labor force. I mean, again, this is accelerated by the pandemic, but that need to suddenly switch to remote working and shift entire workforces into a very different environment. That was only enabled because of what was happening with AI. So, for us, AI is a very different opportunity to what's happening with robotics and automation. We do see, there's a little bit of overlap. You'll see about 10% of the companies in our AI strategy are also in the robotics strategy. So that, they've obviously got something in common. That goes without saying, but they are different opportunities. We think certainly it's not a mistake, but to try and merge them into one strategy becomes a little bit complex into really trying to sort of identify effectively pure play. So companies that have a high revenue association, you see a much lower revenue purity across our AI universe than you do with robotics and automation. It's just a fact. It's just where we are in terms of the AI opportunity. So, with AI, we actually spend a lot more time looking at things like how companies are investing into talent, into human resources. We'll talk to the head of HR and understand, well, how many, data scientists and analysts do you actually have on the books today? How many open headcount do you have? What's your retention rate? Because, that is almost, part of being a sort of future indicator of their success and their anticipated revenues from the theme.
Yeah, no, absolutely. That's really fascinating. Actually, I hadn't quite considered the kind of nebulous nature of AI and how it's potentially harder to classify than some of the other themes that you guys are tracking. Well, let's finish by focusing on the indexes more specifically, just talking about sort of your classification system, portfolio construction, or index construction, I should say, before we finish with our quick fire question round. So, first of all, let's start with industry classification. I mean, each index aims to identify stocks exposed to their relevant theme, of course. So, for example, I read that stocks exposed to robotics and automation for your ROBO index are given a ROBO score from 1 to 100. Again, you referenced that earlier. So let's dig into that now. What factors or metrics are used to actually gauge that score?
Yeah. So, as you said, Hayden, across each of the three strategies, so, again, robotics and automation, AI, healthcare, tech, and innovation. First step for us are the subsectors. So, what does the roadmap look like where we want to invest at that forward-looking view? And, that's something that evolves gently over time. So, you'll see, a subsector, perhaps morphing or, having more areas of coverage or potentially an entirely new subsector emerging. But the first criteria to come into the strategy is that a company's got to fit into one of the subsectors. So they've got to have, their business has to be associated with one or more of the subsectors. We also very early on applied the ESG policy as well. So, if companies don't tick both of those boxes, they're automatically going to be excluded. What happens next is that all of the companies, as you said, get a score. We call it a ROBO score. And that score is really derived from 4 factors. The first is we will look at their revenue purity, and we express that as a percentage. We then give a 1 to 5 rank for each company across their technology. So really that's almost at a benchmark. We'll look at their peers. We'll say, whoever's got the better technology is going to get the higher ranking score there. We also give a rank in terms of their market leadership. So market leadership, we get pretty deep into sort of the financials, the business, the market share, the margin, the management teams of the companies. And again, 5 is your higher score, 1 is your lower score. And then the final factor is investment. I was just talking about that earlier with the artificial intelligence strategy. So it's not just CapEx investment into the theme. We'll look deeply at how they're investing into talent, how they're building, development centers, training centers for customers as well. So those 4 factors, the revenue purity, market leadership, tech leadership, the investment, they get combined to give a company a 1 to 100 score. Anyone that scores over 50 can potentially go into a strategy. And if we have overlap, for example, I mentioned surgical robots earlier. We don't want 4 or 5 surgical robotic companies. We just want the top 1, maybe 2 companies. So then we'll use the company score to determine who comes in. And then the company score will also actually dictate the weight in the strategy. But given how the scores fall, that's where we tend to end up with this 1 to 2%, which again, we really like. We call it a modified equal weighting.
Yeah, fantastic. That's a great explanation of it. I actually had a question specifically on market and technology leadership, just trying to understand what that is, but I think you've cleared that up. So that gives us a really good idea about how you identify index constituents and kind of what a company needs to do, needs to exhibit to be able to be considered to be part of the index. But then in terms of how you bring all of those potential opportunities together and make it a diverse, strong, robust index, let's talk about how you construct those products. So if your website, again, I think references the methodology should actually minimize risk by limiting reliance on large cap players. So this is something you very briefly alluded to earlier on in the interview. So a lot of thematic funds, again, as we've discussed, are heavily exposed to the theme's leaders in inverted commas. So is this a key point of differentiation for Robo? Do you actually actively look to exclude those large cap players that characterize the rest of the indexes and products within this space?
No, we don't actively look to. It's more an outcome, but certainly when you look at the robotics and automation strategy and the healthcare tech strategy, they've got a much heavier tilt to small and mid cap companies. So you don't see the sort of the super large cap companies in there, but that's simply that's an outcome of the company score. So we score all of the companies that are relevant to the theme, but particularly when you look at something like revenue purity, whatever strategy you're looking at, it is just a fact that Google's revenue is 98% advertising related. So, do they belong in any of our 3 strategies or other thematic strategies? I'll leave your listeners to sort of, decide, but, that makes it difficult often for these companies to come in. The difference with our 3 strategies is the AI, our AI strategy does have more of a tilt to large cap companies. That's kind of almost the nature of where we are with AI. In some ways, you need to have deep pockets to be playing, that theme today. So it's a lot of the bigger, more established companies that are investing heavily into AI, and that's across finance. It's cybersecurity, it's credit card fraud. We can talk about warehouse fulfillment. We can look inside big medical companies in terms of clinical research. You've got the whole entertainment industry as well, but it just tends to be larger cap companies. No, we don't actively exclude large cap companies. It's really just an outcome of our scoring process.
Yeah. Okay. Fantastic. That's understood. So then, how do you then go on to, and we've discussed it a little bit, but just to flesh it out, weight the constituents within the portfolio? You talked about the equal weighting there. Can you just give us a bit more detail on that?
Yeah, no, I'd love to. So, we talked about the scoring, and then, high scoring companies then are potentially members of the index. They do have to pass some more traditional index filters around market cap and liquidity. Once they do that, then they're going to go into the index, and their weight will be based on their score. So, the score is effectively going to be anything between 50 to 100. So that then gets equally split amongst a number of companies, which means, again, you end up with this sort of, 1 to 2% weighting. And I think what's really important about the strategy is we've actually very deliberately chosen to reset the index weights every quarter, so 4 times per year. So effectively what's happening now is for the companies that have gone up, we're trimming them, we're bringing them back down to their 1 to 2% position. Companies that have actually dropped, we're actually buying more into them. But this for us has proven to be a really effective way to capture the growth and returns over a multi-year period, but also to really smooth out the ride for investors as well. That quarterly rebalance, also, as well as adjusting the weights, is our opportunity to make member changes. So we might have identified another company that's coming in or another company that's going out, but those tend to be fairly limited. You don't see dramatic changes in the shape of the portfolio. We might have 2 to 3 changes per quarter per strategy.
Yeah, fantastic. Okay, well, I think mentioned earlier as well that these strategies are a way to play proper long-term conviction, buy and hold conviction in these themes. But I guess this will differ investor to investor, but is there kind of a minimum on that? Is it at least 5 years that you need to kind of allow for some of these themes to play out? Do you have any thoughts around kind of what the minimum time horizon might be for these strategies?
Actually, that's a really interesting question. I've never really had it phrased like that. No, no, there isn't. Look, some investors might be lucky enough to, be able to sort of, time this and sort of, buy in, when there's some sort of, cyclical event in the markets. But, no, we think it's just important to be invested in the themes and, to hold over a multi-year period. What's the sort of the minimum hold? Well, it's going to be, our view is it's going to be the longer the better, but there's certainly the opportunity to see returns, year after year.
Yeah.
But obviously, there's other factors at play in the market. But you mentioned it earlier. We expect these strategies to outperform broader markets by a significant magnitude.
Yeah, okay, absolutely. And just on performance then, we won't get into the weeds of this too much with compliance in mind, but the ROBO Global Robotics and Automation ETF is the biggest of the 3 funds, so or indexes. The ETF, or the one of the ETFs that I looked at that tracks this index, is up around 30% over the past 12 months. But since a low in mid-March last year, so mid-March 2020, which of course was around the outbreak and peak of coronavirus, the fund is actually up 141%. So those are stats just to illustrate that this is a popular strategy and one that's performed well, particularly over the last 18 months or so. What about the last 18 months has been so conducive to the popularity of this strategy, do you think?
I think it's been, the rush to, digitize the economy. The pandemic really just stretched a lot of, businesses where we needed, a different set of services provided in a different way. So, the obvious ones, we mentioned them earlier, but, our e-commerce and things like telehealth. And, I think that's continuing today. But, also, we've always had these sort of, broader themes at play where, we as consumers, we want customized goods that are high quality, and by the way, we want them delivered to our doorsteps in less than 24 hours. I mean, we're just fundamentally forcing supply chains to change. Factories are relocating; they're bringing their manufacturing, much closer to the consumer. But they can afford to do that because these are typically higher cost locations because of the automation. But that investment into automation has also become critical because of things like inflation, and rising costs. And even now, I mean, it's just phenomenal how different things feel, but a lack of workers in many industries as well. I mean, as I said earlier, Hayden, I was, slightly joking when I said, we were always battling this question about robots being bad for jobs. The headlines now are the absolute opposite, where, we've got a shortage of labor across many, many industries. And, the obvious tool, it's not going to solve all problems, but, is automation. Automation is actually very good at doing tasks that we're not very good at. We don't like doing. It's dull, it's dangerous, it's dirty. So, let's automate it.
Yeah, absolutely. Okay, well, I think that's a nice point at which to move on to our quickfire question round. I referenced it earlier. So this is something we do with all guests. It takes 1 to 2 minutes tops. And it's a more generic list of questions, I suppose. Just a light-hearted way to end the episode. And you can feel free, I suppose, to answer in as little as one sentence or even one word for each of these 5 questions. So the first question, very general, but what is the top mistake investors make, in your opinion?
Not understanding the underlying portfolio.
Yep, absolutely. Okay, question 2. Where do you go for investment or economic insights? Do you read specific publishers, for example?
We read very broadly, but as it's become obvious in the discussion ahead, and we particularly rely on our advisors.
Yeah, okay. Question 3. Specifically to you then, and personal to you, what is the most memorable moment from your career to date? It might be hard to pick just one, but does one sort of immediately spring to mind?
Yeah, I think one of the first times I went into an Asia-based auto factory that was had invested heavily into automation, and just seeing those factory robots, in operation at scale, it was absolutely phenomenal.
Yeah, great. Okay, our penultimate question then. If you could go back in time, what would be a top tip for your younger self? One bit of advice that you would give yourself?
Keep asking questions, keep challenging, don't be afraid. I think it was a bit of a leap of faith for us to start ROBO Global. We're so glad we did. Follow what you find interesting. It's a lot easier to sort of research it and understand it.
Yeah, completely. Okay, well, let's finish on the Opto question, as it were. We ask everyone that joined us on the podcast this question. What is an investor's best source of alpha? So if you had to narrow it down to one thing, where do you think the great investors derive their outperformance?
I think technical expertise, at the moment, in the context of what we're talking about, is just really, really understanding where trends like we've been talking about are going.
Yeah, no, absolutely. That's come through in the interview so far as well. So that just leaves me to say thank you very much for joining us on the podcast, Richard. It's been a real pleasure.
Thanks, Hayden. That flew by, actually. Really interesting.
Thanks for listening, everyone. Just a quick note before we sign off. If you're looking for an easily digestible daily update on the markets, this might be of interest. Opto Updates is our short newsletter sent every day during the trading week, giving you a bulleted list of the top 7 stories from the global stock markets. We've done the hard work for you, highlighting relevant opportunities and trends. And in addition, we'll also keep you notified of any new products, stock reports, or webinars from the Opto world. If you're interested, sign up using the link in the show notes. And thanks also to Co-Fruition for consulting on and producing the show. Until next time.
Co-Fruition.